Hello everyone, welcome back to my channel. My name is Keshav and we are starting module 2 of our payroll management course. Today we are diving into something that affects every single employee but confuses most people. Payroll components and structure. You know that moment when you get your offer letter and it says your CTC is 10 lakh per annum and you are super excited thinking your salary would be around 80,000 rupees every month, but then your first salary hits and it's only 62k. Where did the rest go? Is the company cheating you? Not at all. You just don't understand how payroll works. By the end of this video, you will know exactly what CTC is, where your money goes, what bonuses you are entitled to, how stock option works, and much more. So let's get started. So first, let's talk about the problem. Before companies properly structured payroll, here is what used to happen. Employees would get their salary slip and absolutely no idea what all those numbers were. They would see deductions they did not understand. Companies would face legal troubles for not paying mandatory bonuses. Tax issues would pop up because allowances weren't structured properly. And stock option, forget about it. Nobody explained them properly. The result, unhappy employees, legal penalties for companies, people quitting because they felt cheated, and everyone losing money to tax unnecessarily. It was all chaos. Now, the first attempt to fix this was simple. Company said, okay, let's break salary into three parts: basic, dearness allowances, and house rent allowances. This was a start. At least there was some structure. Basic salary was around 40 to 50% of your total packages. HRA helped with rent, some bonuses here and there. Provident fund was deducted, but this wasn't enough. It did not cover stock option. It didn't explain statutory versus non-statutory bonuses. It ignored variable pay. Nobody talked about fringe benefit. So let me break down what CTC actually means. CTC actually stands for cost to company, the total annual cost of the company spends on you as an employee. It's a way more than just the money hitting your bank account every month. Look at these four main buckets. Number one, basic salary. Number two, PF and ESI. Number three, bonuses. Number four, benefits. Here's the key thing to remember. I want you to write it down. CTC does not equal your enhanced salary. Your actual take home is always lower after all the deductions and contribution. Got it? Good. All right. Now let's talk about bonuses. What is a bonus? A bonus is additional money given to the employees over and above their regular salary. It can be either a reward for performance or legal obligation the company must fulfill. Now there are several types of bonuses, and you need to know the difference. First, statutory bonus. This is required by law. Festival bonus, think Diwali bonus, New Year bonus, these are tied to celebration and cultural events. Third, performance bonus. This depends on how well you performed, your targets, your achievement, your KPIs. Fourth, profit sharing bonuses. When the company does well, they share a portion of those earnings with employees. Now, let's understand the simple rules about bonuses. Here are three critical rules about bonuses that you must understand. Rule number one, tax implication. Most bonuses are taxable. They get added to your annual income and you pay tax according to your tax slab. Rule number two, legal requirement. Statutory bonus is mandatory if the Payment of Bonus Act applies to your organization. This usually kicks in when a company has 20 or more employees. The minimum statutory bonus is 8.33% of your salary. Maximum is 20%. Rule number three, company policy. Festival bonus and performance bonus are the bonuses which are on company's choice, not legally required. But they should be clearly documented in your employment contract and compensation policy. Never assume you're getting them unless it is written. Let's talk about something really exciting: stock ownership programs. Companies, especially startup and tech companies, offer these to attract and retain top talent. Basically, they are saying, we want you to be an owner, not just an employee. There are three main types, and they all are different. So pay attention. Number one, ESOP, Employee Stock Option Plan. With an ESOP, the company gives you an option to buy its share in the future. Please pay attention to the option. You don't have to buy them. Usually, they offer you a discounted price or fixed price that's lower than the market price. Example, company share are trading at 500 rupees per share, but they give you option to buy them at 200 rupees after 2 years. If the stock goes to 800, you make big profit. Number two, ESPP, Employee Stock Purchase Plan. This one is different. Here, the company allows employee to purchase company share regularly through payroll deduction. So every month, a small amount from your salary goes towards buying company stock, often at a discount of 10 to 15%. This is great for long-term wealth building. Number three, RSU, Restricted Stock Units. These are promise of share in future. Company says, after you complete 3 years with us, we will give you 1,000 share. After vesting, those promises convert to actual share or cash, usually given to senior employees as a retention tool. Okay, now We come to allowances. These are super important for tax planning. Let me go through the main areas. HRA, house rent allowances. This is for your rent expenses, partially tax exempted. If you live in rented accommodation, you can save a lot of tax here if you claim it properly with documentation. Conveyance allowance, mobile and internet reimbursement for businesses, partially tax exempted. Food coupons, meal voucher or food allowances, tax exempted up to specific limit set by income tax regulation. LTA, leave travel allowances for vacation travel within India, tax exempt twice in block of 4 years. But you need proper documentation, ticket, boarding pass, hotel bills. Medical reimbursement, health insurance premium and medical expense coverage. Various tax exemption available under different section of the Income Tax Act. The key with all these allowances is deduction. Documentation. Keep your rent receipt, keep your travel tickets, keep your medical bills, otherwise you'll pay tax. Now let's talk about variable pay. What is variable pay? Variable pay is the flexible portion of your salary that depends on performance. Unlike your fixed salary, which you get no matter what, variable pay is earned. It depends on four main factors: individual performance, team performance, company performance, and sales targets. Typically, variable pay ranges from 10% to 40% of your total compensation. Sales roles usually have higher variable pay, sometimes even 50%. Support roles like HR and accounts or finance usually have lower variable pay components, around 10 to 15%. The philosophy here is simple: perform well, earn more. Company does well, you get benefit. Statutory versus non-statutory benefit. This is a critical distinction you must understand. Some benefits are mandated by law. The company has to provide them. Other benefits are the company's choice. They provide them to stay competitive. Let me break this down. Statutory benefits are mandatory by law, such as provident fund, employee state insurance, gratuity, statutory bonuses, minimum paid leaves, maternity benefit. There are also non-statutory benefit, which is company's choice: additional health insurance beyond what ESI provides, wellness programs and gym membership, flexible working arrangement, learning and development budget, extra leave days, employee assistance programs. Here is why company offer non-statutory benefit to attract, retain, and motivate top talent. If two companies offer the same salary, but one has amazing benefit, which one would you join? Exactly. Now we come to the fringe benefit. There are non-cash benefit companies provide. And here's the thing: even though they are not cash, they have monetary value and the government taxes them. Let me explain. Company car. If the company provides you a vehicle for business and personal use, it's taxable for the personal use. Company accommodation. If the company provides housing, the taxable value is calculated as a percentage of your salary. Free meals. Food provided at the office or workplace. If the food is provided during work hours and office premises, it's tax exempt. Paid holiday trips. Vacation packages sponsored by the company are fully taxable as a perquisite unless it's business travel. The important thing to remember here is these fringe benefits have monetary value. The government will tax them as perquisites. Proper valuation and reporting is essential for compliance. Your HR and finance team needs to calculate this correctly, or both you and the company could face tax issues. Alright, let's wrap this up with the 7 key takeaways you need to remember. Number 1, CTC breakdown. Understand the difference between total cost to the company and your actual in-hand salary. Number 2, bonus and legal requirement. Know the type of bonuses: statutory, festival, performance. Understand which are mandatory by law and how they are taxed. Number 3, stock programs: ESOP, ESPP, and RSUs. Number 4, allowances and benefits. Learn the tax treatment and exemption. Claim them properly with documentation to save thousands in tax. Number 5, variable pay. Understand how performance incentives are structured. Know your KPIs and how they translate to earning. Number 6, statutory versus optional. Clear distinction between what is mandatory by law and what's company's choice. Use this knowledge during salary negotiation. Number 7, fringe benefit. Understand proper valuation methods and tax implication of non-cash benefit. Don't get surprised by unexpected tax bills. Look, payroll components can seem complicated, but once you understand the structure, you can negotiate better salary packages, plan your taxes more efficiently, take full advantage of the benefits your company offers, avoid surprises when your paycheck arrives, build long-term wealth through smart compensation choices. Now, here's my challenge for you. Go pull up your salary slip and see if you can identify all the components we discussed today. Drop a comment below telling me what percentage of your CTC is actual your in-hand salary. And if you find this video helpful, do me a favor, hit that like button, subscribe to the channel if you haven't already, and share this with anyone who is confused about their salary structure. Until next time, this is Keshav, and remember, understanding payroll is not all about money. It's about being a smart professional. See you in the next one. Bye bye.